We're taking a look at the currency market now with Shireen Darmalingam, Macroeconomic Strategist at Standard Bank. Thanks so much, Shireen, for joining us this morning. Well, we've got headlines reading Europe finally recognizes the crisis because, while we had the ECB failing to cut rates last week, its announcement of further unconventional easing combined with government's efforts to recapitalize banks has certainly kept the mood optimistic, along with France and Germany's comments this morning as well about a substantial plan being put on the table by the end of this month. The question is Europe finally getting its act together?
Well, I hope so. I really do hope that they are getting their act together. And the fact that the Belgian bank is really one of the first of all, on the back of this European debt crisis, really shows how urgent the current situation is. So we do hope that the German and France team do put together some recapitalization plan that will help to bring the Eurozone out of this debt crisis. And hopefully sooner rather than later. We do have about a month to go, just under a month to go before we get those resolutions coming through. So the next couple of weeks is still going to be fairly tight and fairly volatile and could possibly impact our currency very closely, because over the past couple of weeks we've seen the rand take its cue from global sentiment rather than what has been happening domestically.
That's exactly it. I mean, the developments that we have seen abroad has had a massive impact on emerging market currencies with outflows of capital from emerging markets on account of the liquidity squeeze really exerting pressure. If you're looking at the South African rand specifically, nothing's changed in terms of things on a fundamental basis in South Africa, right?
No, it hasn't. In fact, on Friday we saw the rand remain below the 8 rand level, and that was really on the back of the encouraging US payrolls data. We also have the manufacturing data and mining data coming out this week, but those numbers are not really going to impact the currency too much. We expect the rand to continue taking its cue from the global sentiment and really looking at the shifting expectations of global growth, which could be the dominant force going forward. So it's really going to remain at the mercy of what's happening in the international environment.
Nevertheless, we are, as you say, anticipating manufacturing and mining data. What are your broad expectations on those fronts? Because lots of concern that these are two sectors that could be, in a recessionary mode. Of course, we've got mining already in that recessionary phase, and the fear is that manufacturing will soon follow.
Well, we did see the second quarter produce negative manufacturing growth rates coming out of there, but we do expect a slight improvement in the manufacturing data. We're out of consensus, or out of line with consensus view of a still negative growth number for August. We're expecting an increase of about 0.4% year on year, but that's coming from negative 6% the previous month, a growth of negative 6% year on year. We do take some kind of indication from the latest PMI data, which saw 7 out of the 10 components showing positive increases and remaining above the 50 benchmark level. But some concern is coming through from the fact that the employment index of the PMI has remained below 50 and is going to continue to pressure the manufacturing sector lower. We do expect some sort of a direction from the mining sector as well.
Looking forward to today, because I'm not going to dare to ask you to forecast the rand and its trading range for the week ahead, but for the day ahead, Shireen, what are we looking at against the dollar?
Well, we did see the rand coming firmer this morning. So if rand bulls do breach 7.86 to the downside, we could see a move towards 7.74. However, if we do see economic data come out a little bit worse than expected, we could see a move back towards 8.10.